Hello, everybody, and welcome to our class. Today, we're going to talk about spread options, bulls versus the bears. We're going to talk about a very popular and highly recommended strategy, and also a very common strategy that can help you not lose a lot of money. And if you're making money, then it's going to be not bad, but we'll see how it works. Okay, so spread options basically is again, very common strategy. It comes to hedge one side written option by buying an out of the money option at the same quantity. That means that whenever we're considering selling naked option, we should always consider making it a spread and spread strategy. That means that if we might sometimes think that we are pretty certain about one direction of the market and we think that it's going to go this way and we're selling the right option for this way, but sometimes the market can be evil to us and give us some serious suffering, and we might lose money, and we don't want to enter this, because if you remember the first class that we've spoken about writing options naked, that basically meant that if the market goes against us, we might lose an endless amount of money because we're not protected. We don't hedge anything. We don't have anything to be hedged. Nothing can come and help us. And that might be very, very dangerous and very not smart strategy. And this is why the spread options strategy comes to help. So there are basically two kinds of spread options, spread strategies. The first one is the bear, and the other one is the bull. So we're going to talk about the bear, and the bear spread strategy is another form of vertical spread. In this strategy, the investor simultaneously purchases put options at a specific strike price and also sells the same number of puts at a lower strike price. Both options are purchased for the same underlying asset and have the same expiration date. This strategy is used when the trader has a bearish sentiment about the underlying asset and expects the asset price to decline. The strategy offers both limited losses and limited gains. So let's have an example for a bear put spread. So in this example, we're considering that the underlying right now is at 105. And what we need to do is, since we're thinking that the market is going to go down, but the put 110 cost us $10. And this might sometimes be considered as a expensive option. And we want to reduce the amount of this cost, and that's why we're selling a put 100, and it's gonna bring us a $5 profit. Now I know that I gave you the example about selling in dip in the money strategy, and we're gonna see that, but take in mind that this strategy can be composed in both ways. And well, we're going to show both examples pretty shortly. But one way to do this strategy is buying the put, which is dip in the money, and selling one put out of the money, so that it will reduce our costs. And let's see if, excuse me, the okay, so this strategy goes for 30 days, multiplier is 1 as usual. And we're talking about expiration day. And since the market was at 105 and the expiration came at 80, it fell pretty badly. So here you can see our securities in this graph, and that we're going to spend $5 constantly. That means that we bought the put 110 for 10, but we got 5. So all in all, We're always going to spend money, and that's going to cost us $5 anyway. So if the expression was at 80, put 110 worth $30, but put 100 is going to cost us 20. That's because he entered the money, and it's worth for us minus 20. So all in all, the P&L, profit and loss, net value of us is going to be 30 from the put 110 that we got at the expiration. Now we have to deduce 20 because put 100 is worth minus 20 for us. And remember that all in all, we also spent $5 for buying those two options. So that gives us a net profit of $5. Expiration in 90, pretty much the same. Put 110 is worth 20, and put 100 is worth against us, minus 10. Then the P&L calculation is 20 minus 10 minus 5 equals 5. That means that we made $5 profit. What happens at 100? Pretty much the same. Put 110 is worth $10, but put 100 is 0. So that's why we're still staying at a $5 solid profit. Not bad. What happens if the market rose a little bit? And now here comes the tricky part. Now it went up it stayed at 105. And that means that put 110 is going to be worth only $5. Remember that we bought it for 10. But put 100 is out of the money now, and is pretty much worthless. That means that he's 0. So all in all, we got $5 from the put 110, but we still spend $5 in total for those two put options. So that's why it brings us at 105 at our break-even point. This point here, that means that we're break even. If the market rises and goes seriously against us, and let's say it's expired at 120, so we lost. And we lost, the put 110 and put 100 both are worth 0. And they don't pay us anything, and the market seriously went against us, and we lost $5. And this loss will remain $5. That means that if we hadn't sold the put 100, that means that we have lost $10 and not 5. And that 50% difference between those two, and that may be pretty significant for many traders. If this is a good strategy, because if you're not pretty certain that the market is going to go down in this kind of strategy, then, and you don't want to spend the whole chunk of money that this option costs, then it's a good strategy because it reduced our losses. And that's the difference between losing $10 and $5. That's a big difference. Okay, so this is strategy for if you're thinking the market is going to go down. Now, let's say the bulls. The bull strategy, exactly the same, but it refers to for the upside. In a bull's call spread strategy, the investors simultaneously need to buy calls at a specific strike price while also selling the same number of calls at a higher strike price. Both call options will have the same expiration day and underlying asset. This type of vertical spread strategy is often used when an investor is bullish on the underlying asset and expects moderate rise in the price of the asset. Using this strategy, the investor is able to limit their upside on the trade while also reducing the net premium spent, comparing it, of course, to buying a naked call option outright. Again, the same strategy, but this time, same example also, but this time we're going to buy the call 100. The strike price is 105, and we're going to sell call 110. We're going to receive $5 from selling out of the money call 110, and we're going to buy the call 100, which is in the money and we're going to spend $10 for it. Now, remember, always there is some kind of extra premium that we have to pay for options that are still alive. That means that they still have days till they expire. So it's pretty common, and you're going to pay extra premium for that. And so in this strategy, again, we're spending $10 but receiving $5 back. So we're all in all in total of minus $5 on this strategy. And now let's see if the stock expires at 80 on this same example. Remember that we are bullish on the market. That means that we're thinking the market is going to rise, and it unfortunately it fell all the way to 80. So in this way, we're pretty much screwed, because call 110 is worthless, and also call 100 is worthless. So since we got $5 from the call 110, and still we have spent $10 for the call 100, all in all gives us a net loss of $5. Also, same happens at 90 strike and 100 strike. That means that we're going to lose all our initial strategy building, and that's $5. So as you can see in the graph, at 105 strike price, expiry day, if it expires at 105, then call 110 it's going to be worthless, but we're going to get $5 from the call 100, worth $5 in this expiry. So 5 minus 5 equals 0. So at 105, this is our break-even point, and every single point above 105, we're going to make $5. We're going to make a few more dollars. We're going to make at 106 $1, at 107 $2, till we reach the expiration at 110, and that means that again, call 110 is going to be worthless because it expired exactly on the spot, but call 100 is going to be worth $10 exactly. And remember that we spent $5 more. That means that we're staying stable at $5 profit, net profit, and so on and so on. If it expires at 120, we're going to make $5, and if it's going to expire at 200, we're still going to make $5. Excuse me. So this is the example of the bulls and the bears. So why is it such a good strategy? I want to show you now on the trading platform. And here we can see the example on the QQQ. And as you can see, it's been traded today around 333. That's the market. QQQ goes on the NASDAQ. And we're looking here at the option chain. And we're looking at this quarterly expiration chain, which has right now 29 days till expiration. And we can see that the implied volatility on this asset isn't so high. And we're thinking that the market is gonna rise, but not too much. So we're gonna see that we're gonna make the spread. We're gonna see that call 330 is around $9.40. So that's where we're gonna buy it. Excuse me. And we don't think that the market is gonna go rise above 340. And let's say we got $3.40. So that means that there's a gap here of $600. And let's see our risk profile in this kind of strategy. So we're saying here that we bought the call 330, cost us $9.40. And if we were to buy it naked, remember that it's pretty expensive for 29 days. That's a total of $940 if you're buying it naked. And if the market doesn't go up or is not rising, at all, then we're going to lose this whole money, this whole $940, almost $1,000. That could be severe. But on the other hand, we don't think that market's going to rise too much above 340. We're going to think it's going to stay here between 335 and 340. So that's why we're going to sell out of the money, call 340, and we're going to receive $340. Now what happened? We deduced $340 from our initial maybe loss, and the maximum we're going to lose now is just 600. On the other hand, once the market reaches 340, we're going to make a solid $400 profit, net profit. Keep in mind that also this kind of strategy does not require any margin requests, and the theta effect is pretty small now. Maybe it goes against us, but it's pretty small. So this is as you can see, if it rises, we're still going to get $400. If not, then we're going to just lose $600. Again, without it, we would have made a little bit more. But we're not certain. I don't think that the market's going to make 350 in if you think, and that the market's not going to make it to 350 in 29 days, then you can see here that you have a potential profit of $1,000 approx. But if you don't want to go piggish too much, then you can take $400 here at 340. Now, keep in mind that if the market does expire at 340 and you haven't sold the call 340, then you would have made almost nothing, because maybe $40, something like that. That's because now you're going to get 340, and that's better if it expires right here at this point. So if it expires here, it's better for you. Anyway, it's going to be better for you when you're hedging yourself in this way, and you're going to get $340 less loss, and that's a good thing. Okay, so this is how it works. Now, I want to show you, this is if you go bullish. Now, another way to make this kind of strategy is to, if you're thinking you're going to go long, then you can do it with the puts. Okay, so let's see how it works on the other way. Just a minute. Okay, so now let's see the vice versa strategy for this type of calendar. And this, we're going to see, in this example, we're going to see now how it goes if we're going to try the vertical strategy for this. And it goes pretty much the same on the same option chain, in the same option series. We're gonna sell one put 333, which is in the money, and simultaneously we're gonna buy the put 332, which is currently out of the money. We're gonna get a credit of 0.39. That means $39. And let's see how it looks. Keep in mind, margin request was nothing, just $100. That's the gap between those two options. And this is our risk profile going to look like. Today, we are at 333, and we're bullish on the market, and we're thinking that it's going to rise. So that's why we are, just for the example, thinking it's going to rise up. And we're pretty certain that the market is going to make a significant run on the upside. But simultaneously, we're not too sure, and we don't want to lose a lot of money. So that's why we're not selling it naked, and we're buying instantly the 332 put option, and that gives us a credit. There's always going to be a credit between those two. because we're selling the higher and buying the cheaper out of the money, and we're getting credit. So the credit we got here is $39, as you can see here, from this point and on, going upwards from 333, we're going to make a solid $39 profit. But if it falls down, then we're going to maximum lose $60. Now you can play with it. I mean, you don't have to hedge yourself so closely, and you can say, okay, I want to earn a little bit more money, and I don't care if I'm going to lose a little bit more. So I don't have to hedge it on 332. I can hedge it on, let's say, 330. This way I'm going to get higher credit of 1.11. That's 11. That's $111. And in this case, I'm going to make $111, or I can live with a smaller, bigger loss of 175, almost $180. So it's either almost $180 loss or a $111 profit. That's nice. That's not bad. You can also play with it. You can even bring those greater. You can sell even higher in the money puts. Like, let's say you can sell the 340. You're going to get even a greater credit. But on the other hand, now you're going to lose much more money. You need much more margin request now, but you can earn almost $500. That's $456. And on the other hand, the maximum you're going to lose is nearly the same. That's $540. So that looks more interesting. You need a greater margin request, but again, this is the game. This is how you can play with those strategies. If this example was on the puts, let's see how we can do that on the same way on the calls. And remember that I told you that we always should keep in mind that selling at higher implied volatility and buying a shorter implied volatility. And by the way, you can always look at it when you go here in charts, and you're going to have product depth, and you can see all the strikes that are coming in this series. And in our example, we were looking at the June 30. You can see the calls and the puts, and you can, I don't know what it looks like that. Okay. Excuse me. So you can see that there is some kind of fluctuation here, and the calls, the implied volatility in the calls at the 3.3 is greater, and the falls, the skew of the implied volatility falls until it reaches almost 350 something 355 nearly. That means that here, out of the money calls, they have a lower implied volatility. So that means that it's better for you to sell in the money or calls and buy out of the money calls. That's good. And it works better when you have this kind of skew that looks like a smile skew. We're going to talk greatly and a lot more in the other courses that I'm going to show you later on, and we're going to talk greatly and much more deeply about the skew and how it's going to be much more efficient for us to play with them, and how should we calculate them and see how we can make much more profit or efficient strategies. So let's see just the example. Let's say we are going and we're going to sell the strike here. We're going to sell it single. We're going to get let's say $750 for this. And we're selling it naked. just for the example, our risk profile is going to look like that. $750 if it falls below 333, but if it goes higher than 3340, then we're going to get busted and we're going to start losing money. So then we're going to have to buy out of the money options. And let's say we're going to buy the 340. We're going to pay for, let's say $4. Okay, it's even greater than, and it's going to, and then we're going to hedge ourselves, and this is how it looks. You see, break-even point pretty close, but we're pretty certain when we're doing this kind of strategy, the vertical strategy, then we can see that we're cutting our losses, potential losses, and we might lose only $350. On the other hand, we can earn $350. So it's kind of a gamble strategy. But I always seriously recommend you hedging yourself, always. And remember, there's a key sentence that says, every hedging is a blessing. That means that always when you hedge and you spend money on hedging yourself and not bringing yourself to a total naked position, it is always a good thing. It is always blessing for you because you don't know where the market might go. And it can go seriously against you and you might lose everything. You can lose a lot of money, and never be too certain about the market or about its direction or where it might go. And if you want to gamble, go to Vegas, but if it's your money and you want to protect it, so always consider doing the spread strategy. It's always going to be beneficial for you. Keep in mind that also in this kind of strategy, anyway, when you're selling options, you're not going to make any more revenue. That means that you're going to make $750 or lose, I don't know, $7,000. But on the other hand, you can earn just $350 and maximum lose $350. I'm sure the second option is way better and way smarter for you to do. And remember, hedging is a blessing. So that's it for now, folks. I hope you enjoyed. Hope you understood it. And I seriously hope to see you in our next lesson. May all of you have good luck. And I'll see you in our next class. Goodbye.